And to set the scene and detail some of the key themes you as an investor need to know to start this year and to get conviction in your investing ideas, Martin Crabb, CIO of our presenting partner, Shaw & Partners, joins me here now. Martin, welcome. Welcome.
Thanks, Nadine.
So I have taken the liberty to whittle this down from your 10 key themes for 2025. But these ones I thought were very key to investors, and hopefully they will answer some of the questions that have already come from Marie and from Adam and from John as well, who are all asking about key themes and sectors. So let's start with rates. Because yesterday, with that CPI quarterly read, it seems to have changed the tone of the discussion a little bit. But does the timing even matter? I mean, safe to say, rates are coming down.
Yeah, I think that's the key point, is that even with what Jerome Powell said overnight around the Fed being kind of on hold to see what Trump happens, we did have the Bank of Canada cut last night. We'll probably get the European Central Bank cut tonight. And it's clear, as you said, after that inflation read yesterday, that there's a pretty good chance that the RBA is going to cut in February now as opposed to May. But for borrowers and people looking to grow their businesses, etc., the reality is your funding costs aren't going to go up this year, Nadine. They're going to come down. So whether it's by 1% or 0.75 or whatever, I think that's really, really important from an investment perspective too. If companies and individuals can get cheaper funding, then it makes equities or anything that's going to grow look more attractive. So I think the entire investment outlook is really underpinned by cash rates coming down. Whether it's fast or slow is kind of less relevant than the direction itself. And
so that, in turn, would breed optimism when it comes to growth.
Yeah, that's exactly right. So corporate balance sheets are relatively undergeared. If companies are comfortable that official cash rates are coming down, and we know that corporate borrowing spreads are already come down a long way from where they were a couple of years ago, then maybe that acquisition looks better. Maybe that new plant and equipment looks better because it's not going to cost you much. So we will see more M&A. We've already started to see some M&A in the Aussie market. Even this week, there's been a couple of takeover bids, right? Fortescue, etc. So I think that just sort of underpins the what Donald Trump calls the animal spirits. If we got cheaper funding to go along with a better growth outlook, then it should be a good year for the market.
I think it was former RBA Governor Glenn Stevens who coined that animal spirits, just going by memory. Really dovetailing along with that is another one of your key themes, which is inflation. Now, I know that we've just said inflation is cooling, going down, but the rate cuts are coming in part because of slower growth. And Martin, it is hard to get a read on what will happen from inflation going forward because we're talking about tariffs and the like.
Yeah, and there's a massive policy agenda that the Trump administration has talked about a lot during its campaign, most of which is inflationary, whether it's deporting workers, which takes labour supply out and pushes the price of labour up, or whether it's the tariffs themselves. If they go really hard, 60% on China, 25% on Mexico, Canada, then that by itself is inflationary. And you might even get tit for tat. You might see other countries put tariffs on US goods, so you get a global thing. So I think the fear of that is probably staying the Fed's hand, and I think that'll just keep longer term interest rates pushing up or staying high. So I still think cash rates are coming down because policy setters have to look at the data. They can't think about what might happen. But I think the market will just keep in the back of the mind that we might see some inflationary pressure, particularly if Trump goes more aggressive on his agenda.
Okay. It's so timely that we're having this discussion because this week, when it comes to another one of your key themes, it seems as if something shifted in terms of the AI conversation with DeepSeek and that big disruption. Now, there's a lot about that we still don't know. However, does that change the massive amount of dollars that are going to be spent when it comes to US listed companies in terms of AI?
Yeah, I think the numbers are estimated something like $300 billion US to be spent this year on AI development, and that's probably more than has been spent in the previous 50 years in terms of AI. Microsoft themselves have come out with a $80 billion number. I think Meta came out with a 60 to 65 billion. So even just two companies, that's almost half that number. So there's some estimates there from consultancy looking at what the spend looks like. Even if the models are more efficient, even if you can do things faster and use less energy, the reality is that companies are looking to deploy AI technology to reduce the amount of workers that they need, or to make workers, probably more importantly, more efficient. So can we give everyone Copilot? Can we help people process more information more rapidly, give better customer service? Can we speed up things like autonomous driving, all these, because these things require very, very accurate AI models. So the quicker we can move to those things, the better. So I think if I'm Waymo or Tesla, I'm going to spend the money that I need to get autonomous driving to the customers as soon as I can. And whether I can do that cheaper or faster with better models is kind of irrelevant. I'm just going to spend the money to get there. So I think that really does underpin that sort of Mag 7 trade again this year.
I was just in San Francisco. You would not believe how many Waymos I saw on the roads. It was actually startling, obviously, because we don't have them here.
Yeah.
It's happening. The future
Absolutely,
is now.
it's here. Yeah.
Okay, so another one is, we've already referenced it. The conversations will continue to do so be through this session, but Trump being the wild card. We hear a lot about tariffs, but the ultimate goal is to strengthen U.S. manufacturing. And so this goes with a question coming from one of our viewers, Stuart. He says, what impact will those tariffs potentially have on equities? Because, his goal, as I said, is to strengthen the U.S. manufacturing complex.
Yeah, and I think that's where you need to get really selective. So there are certain industries that, that Trump would like to see strengthen onshore manufacturing. A lot of those are in the like the semiconductor space. So those businesses that have got manufacturing capability in the United States will get protected. Another area, and this is probably where a stock story comes in, is in steel. So BlueScope Steel, which is listed on the ASX, BSL's the ticker, have quite significant operations in North America. And the Chinese have been exporting cheap steel into China for a while, into the US for a while, and so steel companies over there have really struggled. So that's one that might be a beneficiary actually from higher tariffs. So another company is Ansell, ANN's the ticker. So they sell a lot of gloves and healthcare equipment into the US, manufactured there, and they're competing with Chinese exports. So again, there's a couple of stocks that actually are beneficiaries of higher tariffs. Higher tariffs are generally bad, right? Consumers have to pay more for goods. You get this tit for tat, and it can impact world trade. So tariffs, generally speaking, for the economy are not a good thing. But it's a classic case of the macro might be bad, but the micro could be quite positive. So I think this is a real theme around this year too, Nadine, is we need to be selective. We can't just buy the market as a whole. We need to get selective because there'll be winners and losers from this. Okay.
Trump has made some pretty big steps away from global climate action, and that's just in the first week or so that he's been in power. Now, obviously, one man does not change what is really, an evolution, a paradigm shift when it comes to climate. However, what does that mean for key sectors in 2025, including nuclear?
Yeah, that's a really interesting one. So the woke agenda, as Trump likes to call it, with his green and banning fracking, all that sort of stuff. He's always said drill, baby, drill. So I think there's two sides of that, Nadine. One is to get the fuel price as low as possible, because obviously America's a big user of energy, fossil fuel energy, to create the US into an exporter of fossil fuels. So that's definitely a Trump agenda. Whether his drill baby drill actually happens, because the economics need to work. But I think the other side of that is the US going to continue to rely on fossil fuel to generate electricity? Because if we're talking about autonomous vehicles and electrification of the grid and all this sort of stuff, and AI, we're going to need more energy and more electricity. So I think that's where nuclear plays a part. Because even if you don't believe in the AI infrastructure spend, there's enough electrification and increased electricity consumption to warrant better fuel sources. And I think nuclear, countries that don't have it, it's challenging, but countries that have it, like the US, like Germany, like Japan, like China, are looking to expand the nuclear capability. And there's just not enough uranium. There hasn't been any investment in uranium for since Fukushima, really. So 20 years, there's been no capex spent at all. So I think we're going to see more mines come on stream, but more importantly, we're going to see much stronger demand. And there's just not enough uranium out there. So I think that's a sector that will do really well this year.
So that's a sector, stock within that you've got high conviction.
Yeah, look, Paladin Mining's our favourite amongst the large ones, and Bannerman Energy amongst the small ones. So they're our two go-to stocks in uranium.
Got it. Now, another key theme for 2025, was healthcare. Now, this is an interesting one because this is being impacted by AI, but it's also being impacted by demographics, which is another one of your 10 key themes. How should investors be thinking about healthcare?
Yeah, there's two areas that we're really excited by, and one's probably really well known, which is GLP-1 drugs. So between Eli Lilly and Novo Nordisk, the data that's coming out of these studies is fantastic from a health perspective. Like people are losing a lot of weight, but it's not just the weight that's coming off. The probability of them getting cancer, of getting heart disease, of getting diabetes, like there's all these other issues that go with obesity that are being resolved and improved, and sleep apnea is another one. So, more people will take GLP-1s, they'll become more available. People are working on oral delivery because at the moment it's an injectable. And I think that whole space, like it's a huge problem. There's 800 million obese people in the planet. So that's a huge area. So going overseas and getting those stocks, more locally, nuclear medicine. It's got nothing to do with nuclear energy, but nuclear medicine, which is using radioactive isotopes to help diagnose cancer in the body and then potentially cure it. And there's a few companies doing it globally, but one Australian-based company, Telix Pharmaceuticals, TLX is the ticker, they look like they're doing a bit of a land grab. They're buying lots of capability. They're buying, they're buying in the US. They're buying in Europe. So they're expanding, and the company's starting to generate some really good profits and cash flow. So it has performed particularly well, but I think this has got a really exciting outlook.
I think a viewer had emailed in a while back saying, is Telix likely a takeover target for the likes of a global pharmaceutical like Novartis?
Yeah, look, I think they always are. They're mostly a diagnostic company at the moment. The issue is, can they use the same technology to become a therapeutic company? So difference there is there's a difference between detecting whether you've got cancer than actually being able to do something about it and cure it. So if you can dial up the radioactive isotope, so they've got clinical trials going for that at the moment. We'll probably start to see results of that this year. If they show themselves to be a therapeutic company, or they call them a theranostic, so they're both diagnostic, they become incredibly attractive. And there's a lot of big players in the industry. So some of these big global pharma companies will be looking at saying, how do we boost our nuclear medicine? Here's an Aussie company. So I think, that'll get spoken about, again, as part of the M&A theme. That'll get spoken about this year as well.
Okay. Now here's a question that I think does tie in with it all, coming from Gary. He says, Jim Chanos believes that the data center sector is overheated. Do you agree? If so, is Goodman overpriced?
Yeah, look, it's a very interesting story because we had significant downward moves in the data center companies earlier this week, right? So after the DeepSeek information came out, I think Goodman was off 8%. I think Digico Infrastructure REIT was off 10 or 11%. There's definitely been some inflated valuation, and some of that's coming out of the price. Have we seen the worst of that? Difficult to say. I still think, going back to the early point about CapEx, Nadine, $300 billion is going to be spent by the Mag 7 on AI this year as part of a much bigger spend. The US government wants to spend $500 billion. A lot of that's got to go into infrastructure. So I think it's still an interesting place to play. I wouldn't be surprised if there's more volatility and maybe the sector marks time for a bit while we see how this plays out. But I think it's a longer term thematic you can still invest in.
And another question coming from Martin, and this is sort of a general one, but a lot of those key themes are global themes. I'd say none of those were only specific to Aussie listed equities.
Yeah.
He writes, global equities is my investing universe now. Is this wise?
Yeah, I think the Aussie market's great from the perspective of being a little bit more defensive, paying you fully franked dividends with stable monopolistic businesses like banks and iron ore mines and supermarkets. But all the action is in healthcare and information technology. And yeah, we've got CSL, we've got ResMed, we've got Telus, we've got some really interesting companies, Xero, Block, Hub, 24. There's some really good companies in those industries, but the action's all offshore. I think you've got to be global healthcare and global IT. So I think having a mix is really important. We advise all of our clients, yes, you've got an Aussie equity portfolio, it's done very well, fully franked dividends, etc. But mix it with the global, because then you get the healthcare and the IT as well.
Yeah, okay. And just to wrap it up, Martin, we had an opportunity to speak earlier in the week. And when you're thinking about these 10 key themes, you told me consistently throughout the year, you're going to be reminding yourself whether something is signal or noise. Just explain that to us.
Yeah, so I think there is a lot of noise, and obviously you need to have Donald Trump and Elon Musk's X feed as part of your daily reading, like read the AFR, listen to ausbiz, get your information. And there's a lot of noise in that, and things change quite a lot. So I think it's really important to focus on the signal, which is what's happening to growth in the economy, what's happening to corporate profits, and what evaluations look like. And if you stick to those kind of key things, that's the signal that you'll be okay. Don't get caught up in the noise. That's really important.